fantastic.
All right, let's get a check on the markets this morning with our task force. Joining us right now from First Trust Advisors, senior economist Bob Stein, and from Ace Investment Strategies, chief trader Yu-Dee Chang. Gentlemen, thank you for being here today. Why don't we talk a little bit about what's happening right now with the spread of this concern about the European contagion, Spain now being downgraded as well. And Bob, does this the downgrades themselves, how much does this increase the chance that the debt will have to be restructured down the road?
Well, I think it's inevitable that the debt has to be restructured. Basically, what's going on here is that a decade ago, Greece and Portugal and a few other countries decided they couldn't run their own monetary policies, and they needed the Germans to do so, and they do it under the rubric of the euro. And now they basically have to admit that they can't even run their own fiscal policies, and they have to get the Germans to do that for them, too. Now, the Germans can't do it directly, so they do it through the European Union and the IMF and partially the ECB. But that's what has to happen here. It can't go on the way it is with Greece's debt at about 115% of GDP, and their interest, net interest payments on the national debt around 5 or 6% of GDP every year.
How did things get this bad, Bob? How did we, I mean, I guess it was hidden. We didn't realize quite how bad the debt was. It's too late to act on some of these things?
Well, for a period of time, they could, Greece, Portugal, countries like this could borrow at almost German level of interest rates because people figured, well, if they're in the euro and France and Germany are in the euro, well, then they probably are good credit risks too, and that was a huge mistake. Greece and Portugal used to default on a more frequent basis before the euro. And frankly, they haven't used the disciplinary force of the euro, where they should have realized they couldn't default through inflation anymore. They would have to default explicitly. They should have used that to improve their fiscal policy over the long run, and they haven't at all.
Yu-Dee, the markets seem to have figured this out. Is it a continued march from here?
Yeah, I think the problem is, Becky, is that markets just don't like uncertainties. On one hand, we're told that this is just not a big problem. These debt problem eventually will get resolved. On the other hand, Germany keeps coming out and saying, wait a minute, we're not saying we really want to be part of it. Markets saying, you know what, guys, just take care of your problem. It's been a month already, and take care of the problem. Can you imagine if somehow California runs in trouble and the United States says, you know what, we're not going to bail them out, go to IMF. I think that's the problem. But on the other hand, fortunately, all these things come out when the earnings are pretty good. So I think market right now is pretty much riding on earnings. Overall speaking, I think market is still climbing the wall of worry. All these are the so-called worries. Eventually, we're going to get past this. Market's heading higher.
Higher meaning how much higher? I mean, what are you talking about? Another 5, 10% from here?
Well, I think depending on whether you're talking about short-term or intermediate term, I think personally,
like 6 months or so.
Yeah, I think 6 months or so, market is probably going to be about maybe 7, 8% higher. I think over the short-term basis, market do not go straight up. I think if you think about it, the major bottom was made back in March of 2009. From there, we since the last correction, we pretty much have a so-called pullback every about 7.5 weeks. This time, prior to 2 days ago's drop, the market hadn't had any so-called meaningful pullbacks for about 11.5 weeks now. So it's about time the market has a little bit of pullback. Now on this Greek debt, on this downgrade of the Spain debt, I think market is finding excuses and coming back down a little bit.
Bob, today we get the jobless claims number, and this is going to be an important number because the unemployment picture has been so front and center, and it affects such a huge portion of the population right now. What numbers are you looking for, and what would be something that would surprise you?
Yeah, our guess is that unemployment claims will come in around 445, 447. The most important thing to look at is the 4-week moving average, and we think over the next several weeks that's going to come down substantially. I mean, we grew at a 3.4% rate, we think, in the first quarter, and that's with the record East Coast snowstorms. We're looking at First Trust at 6% real GDP growth in the second quarter. And consistent with that, you should see initial unemployment claims coming down substantially during the course of this quarter.
Coming down during the course of this quarter, is that going to affect unemployment, or you still think that that will remain stubbornly high?
Well, you know, unemployment right now is 9.7%. Our best guess is that we'll tick down by about on average, not every month, but on average about 1/10 per month. So by the end of this year, we'll be just below 9%.
And Yu-Dee, very quickly, how important are the jobless claims today? Are they eclipsed by what we're seeing both from earnings and from the European situation?
Yeah, I think so. Right now, the jobless numbers, of course, is very important, but basically we know somewhere around 10% is what we're going to have in 2010, and maybe in 2011, somewhere around 9%. Unless it gets substantially better, basically, I think it's already factored into the market prices already.
All right, Yu-Dee, Bob, gentlemen, thank you very much.
Thank you.
Thank you.
All right, coming up, we will head overseas for the latest out of Greece and Spain.